Hi there and welcome to Economic Observations. My name is Chris. Today is the 5th of January and thank you so much for watching. This video is sponsored by the Tanzania School Foundation, a nonprofit near and dear to my heart. There are links in the comments below should you want to learn more. Anyway, let's get started. Today the minutes from the Fed's December meeting were brought to light and they are going to be quite aggressive on tapering and raising interest rates. The Fed wants to raise interest rates on 3 different occasions for a total of 0.75%. I know it doesn't sound like a lot, but at the rate we've been going for the past 2 years, it's quite a bit. And they are also reducing the number of bond purchases, and liquidity and money is going to tighten. So what happens when money gets tight? All right, it makes it more expensive for individuals and businesses to borrow any money. And some may say that it prevents growth in some companies. That's why the stock market reacted the way it did today. Everything was down. Cryptos were down. Everything had an adverse effect because of the minutes of this Fed meeting and what they're going to do. Anyway, it's not necessarily a bad thing for all people. It is really beneficial for savers, right? If people have money in the bank, they will get higher interest rates on that money. Their CDs will pay more, their money markets account will pay more, and savers and people with money will benefit. The people that will get hurt the most are borrowers. It's going to be more expensive to borrow money, whether you're a company or whether you're an individual. So I'll give you an example and you can, it might make sense to you a little bit more. So say you wanted to buy a house and you needed to borrow $300,000 from the bank to buy the mortgage or to buy the house, right? You have to take out $300,000. At 3.5%, let's say you bought the house last month, at 3.5%, over the lifetime of the mortgage, you would pay $485,000. Your average monthly payment would be somewhere around $1,340. All right, so you bought your house, you paid 3.5%, right? You paid top dollar for that house, right? Because that house, let's say, 2 years ago would have been worth $250,000, but you paid $350,000 and you borrowed $300,000. All right, so follow me here for a little bit. So now you want to buy that same house, and this is how interest rates really affect the price of housing. So now let's say, fast forward 6 months or a year, and you want to buy that same house, and you still need to borrow $300,000, but now you're paying 4.5% interest. So when you pay 4.5% interest, your overall payments are going to total $547,000, right? And your average monthly payment is going to be $1,520. So now your payments are, let's say, $180 more. You're paying $247,000 in interest versus the $185,000 in interest. And people are going to look at that monthly payment and say, well, I can't do it. I can only afford $1,340. And this is going to happen all across the country. And I believe the price of real estate is going to come down. And where would you rather be? Would you rather buy a house at $400,000, well above the cost that the house is really worth? People were paying in excess of and having bidding wars and paying more than the value of the house? Or would you rather pay, at a lower price with a higher interest rate? Well, I'll tell you what side of the fence you should really want to be on. You should pay the higher interest rate and a lower price, because when you sell that house, your interest is negligible, right? Because you're going to pay off that loan. So if you borrow $300,000 and let's say the house is now worth $250,000, well, you're going to be upside down in your mortgage. But if you took a loan for $250,000 and let's say you wanted to close out that loan before 30 years, you wouldn't be paying that 4.5% interest. You wouldn't be responsible for the interest when you don't hold the mortgage anymore. Does that make sense? I hope it does. I hope I said that right. Anyway, the same thing's going to happen with cars, right? Because cars aren't going to withstand the higher interest payment, right? So the prices are going to come down. And this is what I guess the Fed has in their toolbox, right? They're going to try and see what happens. I don't think they're going to let it fall precipitously, like in one big swoop, and that's why they're saying they want to do it, 3 times over the course of a year, and then again in 2023. But they realize they have to get the rates up. They have to. Money's going to be more expensive, not only for companies and for individuals, but it's going to be more expensive for municipalities. It's going to be more expensive for, cities and states all across the country. And they're going to have to watch their spending, and they're going to have to tighten their belts as well. So it's going to be interesting times, folks. You can expect a pullback in the stock market. Cryptos are going to come down a little bit. The price of existing bonds is also going to fall, because when interest rates rise and new bonds are issued, people want to go in on those rather than get paid 0.5%. They want the new 2% bonds. So it's going to be interesting. It affects everything. It's been free money for way too long. I have a 401k. Am I nervous about the stock market? Yeah, I am a little bit. I'll be watching it carefully, and if I need to move it around, I will do that. Anyway, that's just my thing on what will happen when the Fed starts tightening their monetary policy. Anyway, thanks for watching. Be kind, folks. Call someone, tell them you love them. We'll talk again real soon, and thanks for watching.